Hi everyone, welcome to Freehold's webinar on listed property and infrastructure markets, or the state of listed property and infrastructure markets. I'll shortly introduce, I'm hoping everyone can see the presentation, state of listed and property infrastructure markets. My name is Omar Khan and I'm one of four investment professionals at Freehold. I'm primarily responsible for our debt strategies, but I also have Grant Mackenzie here with me today, although not physically due to social distancing rules. Grant is a senior portfolio manager at Freehold and will shortly give us his perspective on the state of listed property and infrastructure markets. At the end of the presentation, we'll have some time for Q&A. So please submit your questions via Zoom or email them to communications@freeholdim.com.au. So that's communications@freeholdim.com.au. And again, I think you get at the bottom of your Zoom screen, you can submit some questions as well. So over to you, Grant.
Thank you, Omar. Hopefully you can all hear me loud and clear. Just a bit of background on me. I was at Macquarie Bank. I used to run the listed property securities fund at Macquarie Bank for almost 10 years. Following that, I've had experience doing real estate debt for about 3.5 years. I've worked in a corporate, which is invaluable, and I've been at Freehold for the last 4 years. Now, I was at Macquarie during the GFC, and to be honest, I was pretty hopeful I never had to go through another one of these massive dislocations in the market, but here we are. And what I will say first is it's a little bit different than the GFC. And I think the best way someone described it to me was, the GFC was very much a balance sheet issue for the property sector, where a lot of the REITs had really got quite cute with how they manufactured dividends. They'd pay more than they could afford to do, and it was all about maximising the dividend and hence supporting share prices. And they got very cute with a lot of things they do. This one is more a P&L issue, where the real question mark is about the impact on incomes for a lot of these vehicles. Where will it be in the short term? How long will they take to come out of it? And where will it sort of settle down going forward? So I think they're the real challenges that the people are struggling with at the moment. So if I just look at how we really look at running the funds internally, we're very much focused on pure property and infrastructure like stocks. So what do I mean by that? We're looking to invest in stocks that have long-term leases or contracted contracts in place, so they provide very sustainable and predictable earnings. Now, these earnings are coming from tangible assets, so very much a property or infrastructure like quality, if you like. And what we do try and avoid is those stocks that have sort of more equity-like risks. So stocks that are coming from non-tangible sources, so property management, a lot of property development, which is obviously a lot more volatile, and also we screen for stocks that have got offshore earnings. We typically limit them. So in summary, we look at investing in securities that generate a minimum of 90% of their income via rental or recurring/contracted income streams, and have at least 75% of their assets within Australia. And that's how we really position the portfolio. So if I have a look, March was a month that I think is going to be in everyone's brains for a long period of time. It was one of the most volatile months I think I can ever remember, with stock price movements from day to day all over the shop. So you really had to have strength of your convictions through this period. Look, I don't think anyone is immune to the beta or the downside that the market provided everywhere. But pleasingly, we significantly outperformed the A-REIT benchmark by, almost 9%. And, there's a few reasons for this, but, I think in summary, it really comes back to, what I talked about there earlier, focusing on those, very long-term, secure income streams, and real quality stocks, if you like, rather than some of those stocks that are going to have, some pretty interesting times in our view going forward. But, there's a summary of the numbers. Obviously, the 1 month number is it's a pretty interesting number out there. And I think when you see a lot of the peers coming out in the next, couple of weeks with their quarterly reports or the like, you're going to see a pretty wide divergence of where managers are at, because a lot of managers are very different in how they position their portfolios. So if I turn to the next slide, where are we at? Well, I heard Trump this morning and he summed it up perfectly. Global economies around the world have shut down. And the big question is, how long will it last? And I think that's one of the things, people are really trying to grasp, is how long will it last, and how quickly will we come out of this? We're all aware of the massive stimulus coming out. Governments around the world, fiscal, monetary, I think they're pulling anything they can, given the inherent risks to, the long-term futures of economies around the world. The question is obviously, will it be enough? And, what will be the long-term impacts of, all this stimulus on people going forward? I sort of fear for, my kids as to they'll be still paying this off in their years going forward. I think the impact on company profits is, totally uncertain. You've seen, I was having a read of, I think, UBS's note yesterday, where I think they said over 70 corporates have withdrawn guidance for the full year. Such is the extent of, basically the uncertainty going on out there. And then you start seeing a few curveballs thrown out there. So you saw in New Zealand overnight, the Reserve Bank of New Zealand basically suspended all dividends on New Zealand bank stocks. And, I think there's a few there that are sort of worried that, that may translate into Australia. And what does that mean for a lot of people that are very reliant on, the bank dividends and that to sustain their lifestyles? I think one of the big issues, which, thankfully working in debt markets for a while, I've got my head around, is the debt markets are a massive problem out there, and something we keep a very close eye on. The government is very focused on ensuring there's liquidity out there, and it's a massive focus. But for all intensive purposes, Australian debt markets, issuing bonds or the like, are effectively shut. It's not a huge market. I think, I was speaking to a colleague just this morning, and he said there's been one RMBS deal, I think it may have been last week, and that was only achieved because the Australian Office of Financial Management effectively supported it. So that gives you the heads up as to where the Australian debt markets are at. Offsetting this, though, you're seeing offshore markets, which he was telling me look like they're going to post a record month in transactions going through March. So the offshore markets are open, and we've seen that with Transurban going there and tapping the market in the last couple of weeks a couple of times. But having access to that high grade credit and in a divergent source of market, we think is going to be increasingly important to corporates going forward. Flight to quality, this is how we have positioned our fund, and I think this is the real catalyst for why we performed on a relative basis so well in March. We've always focused on balance sheet and liquidity, and I think it's going to be a key focus for us going forward. I think you're all aware the property markets, despite their perceived defensiveness, were actually more impacted than the equity market through March. And I think this is probably a symptom of how much passive and momentum type funds there are in the market, and ETFs and the like. So, I've always been concerned that some of these passive funds, are beginning to dominate the market. And I think you really saw a lot of this panic type selling through March, and we're sort of hoping that sort of settles down a little bit. And, there's definitely some good buying opportunities out there over a medium to longer term, in our view. And, I think and hope that most of that panic selling is gone. And, you're starting to see some sort of quite sensible money coming in and picking up some of the better quality stocks at, what I believe are, pretty reasonable prices over the medium to longer term. So the next slide, I've just put some property and balance sheet metrics in there, courtesy of UBS. And, a couple of things I take out of this is, one, balance sheets are in good shape relative, although the question is, what is an asset worth out there going forward? From a covenant point of view, there's no one seemingly looking as though they're about to breach any covenants. Speaking to a few people, it doesn't sound like there's any capital raisings imminent in the sector at the moment. And you can see there from an interest cover point of view, obviously looking backwards, but there doesn't seem anyone in the short term that looks in a distressed state. So going into this crisis, balance sheets were actually in pretty good shape. If I turn to slide 7, a chart from JP Morgan really highlights where balance sheets are now versus where they were in the GFC, where, as I mentioned, it was really a balance sheet issue where funds were overgeared and paying out more than was sustainable to investors. So balance sheets are in good shape, but as I said, there's a few question marks going forward as to how they look, when obviously there's going to be some adjustments to asset values going forward. We also invest in infrastructure in the fund, and we have 4 positions in the fund. One is Sydney Airport, where we had an overweight position. We sold down to market weight, basically when it was over $9. We bought back in a little bit when it got to about $4.50, thinking it's oversold. I think the question we're having here is, it's a fantastic business over the medium to longer term. But when do you come in and pay for that potential upside, and how long will it take to really come through? Obviously, I think the market's looking at the next 12 months and realizing that it's going to have a pretty tough time. But if you look through that, where does it get to after that? Importantly, they've got plenty of debt capacity there. So I think this is one of the real big concerns for us, that we look at and we go, no, it's a great asset there. It's a monopoly asset, and their balance sheet, their liquidity is in good shape as well. Transurban, they've obviously, as I mentioned, they've been in the debt markets over the last couple of weeks. They've done a fantastic job, in our view, basically getting ample liquidity to continue with their ongoing construction programs, as well as running the business. They've revised their distribution guidance to pay out their revised level of free cash flow, which is obviously going to be impacted by the lower traffic numbers out there, but that's okay. I think that's a very sensible approach. And as you can see there, their weighted average expiry for their debt is about 8.4 years. So they manage their balance sheet really, really well. One of the stocks that that actually did really well in March was APA Group. This really comes back to how their revenue is generated. 90% of their revenue is either regulated or take or pay to very high quality corporates. In fact, it's about 93% of their customers investment grade rated. So, to me, this is the crux of what the market was really valuing through March, is the quality of the revenue and the likelihood that revenue is going to be sustainable and not impeded through the period. So, and if you have a look, their average contract is about 12 years. So they're in our view, over the medium to longer term, a really safe place to park your capital and get some quite steady growth going forward. And the other one there is Spark Infrastructure, which effectively owns essential services infrastructure, the poles and wires out there. You look at who the counterparty is paying the revenue, regulated growth. Not the most exciting story, but in markets like this, people are more than happy to own these things, knowing the level of certainty involved with the returns. So if I turn to slide 9, how have we really functioned? We've been very defensive in the fund for quite a while. We've been focused on covenants. We've avoided value traps, I think, which is a really important thing, and we've owned quality. So we've had a massive underweight view on the retail sector for a while. I think retail has been undergoing some significant structural change, over the last 5+ years, where these embedded 5% growth in rents every year when sales are only going up 1 to 2% have become quite unsustainable. You've also had the emergence of online, and now and fashion is really suffering. And if you have a look at the performance through the month, it was really these malls that really got beaten up by the investment community. And you have a look why. You're basically seeing fashion retailers everywhere close their stores. You look at Myer, who are trading, at about 12 or 13 cents at the moment. You sort of question the long-term viability of Myer as a going concern. Then you have a look, David Jones, you sort of have a look what's going to happen there. So I think the future of a retail mall, while structural change was occurring, I think what's happened over the last month is just going to accelerate, that change in social behaviour and how these malls are positioned. So pleasingly, we've been on the right side of that, and that was, one of the big contributors to our performance going through March. The one retail stock that we did acquire through the month was Shopping Centres Australia. And, if you have a look at, what they own a portfolio of neighbourhood shopping centres, which is basically your Coles or Woolies anchored supermarket and shopping centre with about 10 to 15 specialty stores attached. And, I know that, these supermarkets are trading 25 to 30% up on where they were, the same time last week on a week-by-week comparison. I think you're seeing a lot of the retail from the city and other locations and the malls really be directed back into, these local supermarket anchored shopping centres. So, a pretty safe place in our view to park our capital. If I have a look at the office sector is one, I think people's initial reaction was, they'll be relatively immune from this. And, I think versus retail, I think that's true, but I don't think they're totally immune. You have a look, I think this is one that probably will delay the next round of construction in the office sector, which is a good thing. But, you look at changing work practices, and I think, a lot of businesses have realised that working from home has become a little bit easier. So I, for one, like being in the office, but you just wonder if this really does change people's behaviours and the like. That said, look, I don't think they're seeing anywhere near the same levels of abatements and the like that you're seeing in retail. It might just be, a bit soft for a while, and you might not see too many transactions. But I think you are going to see some adjustments in rents and asset values going forward in the office sector as well. The industrial sector, the e-commerce thematic has seen, the Goodman Group has had a phenomenal run. And I think you're just going to see that e-commerce thematic continue, and industrial is just going to continue to be, one of the asset classes that investors really, want to get access to. And then we've also, as I said, held decent positions in the infrastructure space there, where the fund has done very well given the high quality of the cash flows that these funds, that these stocks deliver. So what have we done? We've got a couple of small cap names. If you look at VVR, it's a perfect example. So it got down to a price where you're getting about an 8.5% yield. Basically, they own a portfolio of over 600 service stations, around Australia. Basically, they're on 12-year leases. Your counterparty is Shell, which has got an A- credit rating, triple net leases. So basically, you could accumulate your dividends over the next 10 years and then basically get your money back. And even if they pull out at the end of the lease, you're left with over 600 assets around Australia, that you own outright. So to us, there's very, very little risk in owning something like that over the medium to longer term. So what are we looking to do? I think this morning, the market's going to remain volatile. So we're not diving in here too quickly. We're going to stay quite defensive. We are moving the portfolio around a little bit, but the last thing we want to do is catch a falling knife. I think there's a lot of things going on out there. We're going to continue to monitor the balance sheets and liquidity of these things. And I think the hardest thing of all that people are really trying to get a handle on is, where the income lines for many of these corporates, many of these REITs are going to land. So those that have got a lot more predictability in their income lines for us are where we want to be. So in summary, what are we seeing? Well, we've never seen a government to tell people to stop consuming, which is happening now. So, that's a massive change. Uncertainty, how long will it last? That's a great question. And, I don't think anyone has the answer to that. Obviously, interest rates and the spread to bonds is as low and, is low, and the spread to bonds is as wide as it's ever been. But, it comes back to what income. And as I said, this is the real question out there, and it will have an impact on balance sheets, some more than others. Interestingly, I saw one of the brokers has downgraded Vicinity Centres, which has a stated NTA of $2.44. One of the brokers has downgraded the share price to their target price to $1.22 this morning. And I think this is encapsulating all that uncertainty as to where the rents and the like will be at. But for us, this is not about capitalisation rates, and you see all the analysts going out there changing their cap rates to come up with new NAVs and the like. This is about cash flows, and we're going to stick to that thematic because that's really what will drive stock prices going forward. In our view, there's a fair bit of this still to go. It's going to remain very, very volatile, but we're pretty confident that we'll manoeuvre our way through this pretty well. And there's some fantastic buying opportunities out there, but you just got to make sure you stay on top of things. I think we'll get through this eventually, and the sector will come roaring back because it isn't broken. Sure, there's going to be some short-term hiccups out there, and some challenges, but in our view, it's not broken, and there's some good returns to be had for those that are patient. So with that, Omar, I am happy to answer any questions.
Thanks, Grant. Appreciate it, mate. Now, we've already had a couple of questions, or actually a few questions come through, but for anyone else that would like to ask questions and hasn't as yet, you'll see on the slide, you can email them to communications@freeholdim.com.au or via your Zoom web portal. There should be an option there to send them via chat or the Q&A button. I'll ask the first one, Grant, which is, how do you see the moratorium on rentals playing out, impacting the market or even your portfolio or our portfolio?
The interesting one for me, I have a look at, there was something in the press yesterday where the Shopping Centre Council are in discussions, basically with the Retailers Association and the Farmers Guild and the like to, come up with a solution. And you heard ScoMo, basically last week say, it's up to you guys to come up with a solution. Now, one of the problems has been in retail land that every state has their own laws regarding leases and the like. So what they've tried to do is come up with an overarching scheme, if you like, which will apply at the national level. Now, I think the challenges for a lot a lot of the retailers, I think they're starting to realise how big the potential hole may be in their income line for some of the big malls. Not so much the neighbourhood centres that are, from where we're sitting, trading fantastically, but some of the malls are looking at the numbers and going, there's some big potential numbers there if we have to give rental abatements for 3, 4, 5, 6 months. So, I think they're looking at things like deferral, abatement for a part of and the like. So it's going to be interesting whether they can work proactively together. For me, the first thing I would have done if I was one of the retail landlords is given away basically a rental abatement for 3 months, maybe charge 30 to 40% of rent, because to me, this isn't about the next 3, 4, 5 months. It's not even about the distribution that we get in the next 6 months, right? For me as an investor, I want to see these stocks come out the other side, stronger than ever. So, that's really the challenge. And, as an investor, I don't expect to get full dividends or distributions from these guys, for this period. That's okay. As ScoMo said, we're all in this together. And, if there's a little bit of rental abatement and the like, I think the good landlords are working proactively with their tenants, with that theme in mind that, they want to have an even stronger portfolio coming out the back end. I think they're the ones that'll do well. Those that are so focused on the short-termism of making sure they get every dollar off their sitting tenants and the like, I think we'll have a harder time. And look, no doubt there's tenants out there that are, having a go at trying to extract whatever they can out of their landlords. And, it's a moving feast, really. But, look, I think any landlord worth their salt needs to work constructively with the tenants out there.
Grant, I might do a follow-up question on that for you, because you mentioned neighbourhood centres, and I know you've been pretty vocal historically on retail more broadly. Do you see it playing out differently for regionals versus super regionals? Or, and again, you're pretty vocal on structural change within that sector. Do you see this accelerating those changes?
Yeah, look, I think what is this month going to do to the economy? I think the structural changes, so e-commerce, for example, is just going to accelerate. The structural changes, i.e., buying fashion in a shopping mall versus buying it online. I think you're going to see more and more people do that online. And look, fashion retailers in Australia have been in trouble for the last 5 years. They're not opening stores. Basically, centre owners have been replacing fashion retailers with, I think the new one is service-based industries or food and beverage. So, what's the future of a fashion retailer? Do they need as many shops in some of these big regional malls? Whereas, your necessities that you find in a neighbourhood shopping centre, I think, they're the ones that are going to be quite resilient to, what's going on out there. And that's why you saw the regional malls, Omar, really coppered in March. No one can get a handle on where the rent will come in and where the rents potentially will reset and what asset values will do post this. It's a $64,000 question, and I don't think anyone has the answer. You see what the market's implying out there. And someone asked me the other day, do you think there'll be any corporate activity, given the stocks are trading such a deep discount to NTA? And my answer is I can't see it anytime soon. There's a couple of reasons for that, and one is the income is so uncertain, and asset value is, and hence asset value, revised asset value is so uncertain. And two, the access to debt markets for a lot of these guys, it's not there. The banks aren't looking at doing new business. They're looking at closing current loans that they have in place and then working on their problem children. So, new to bank type loans out there are a challenge out there in this market, despite the fact that, banks are are very well capitalised, especially versus where they were at the GFC. But I heard someone describe it yesterday. They're going to ration out how they allocate that capital going forward because, like everyone, they really don't know how long this will last.
I've got another. This is another retail related question, so I'll shoot it through. Which is which retail landlords are at more risk to store closures in fashion, department stores, etc. So it's kind of a very, very similar thing.
Yeah, look, it's your regional and super regional malls, and I think the other asset class,
So
which
just on that, Grant, in a couple of names, you think
Centre, Vicinity, Stockland have a few that I think will struggle. GPT have a few that I think will struggle.
Right.
So they'd probably be the four. And in the sub-regional space, a good judge once told me that any sub-regional that has a specialty tenant paying more than $1,000 a square metre, you need to be wary. And I think there's a few of them out there. And I don't think the depth of tenant is that fantastic in the sub-regional space. So it's a space that we've avoided, for a long time.
All right. I'm going to keep on. Sorry, there's clearly lots of interest in retail stuff. Next one is, I know you've said less of an impact to neighbourhoods, but a question is, in this move to online for even groceries, do you see bigger changes taking place there?
Well, that's an interesting question. Look, I think people still like to go out and do their, do their shopping. Crikey, I know being cooped up in the house every day, I jump at the chance to go up and do the grocery shopping. And I think it's like an outing, especially in your local community. Look, online grocery shopping, it's increasing, but I don't think at the same speed as your non-discretionary sort of, as your discretionary retail out there. So, as I said, what I'm hearing is some of these Woolworths and Coles stores are up 25, 30% over the same period last year on a week by week basis, which really gives you an insight as to how these centres are performing. And just remember, Omar, that how the leases work in these supermarkets is that every 3 years they have a turnover clause where if they hit the turnover clause, the rent readjusts upwards, and there's a ratchet that means it can't go down. So the landlord will benefit from this, and by default, all the other little centres like the baker and the butcher and the chemist and all that are also in the centre, do well by default as people try and pick up everything there and then. SCP actually put out something the other day and quantified, because they do have their nail shops and the occasional flight centres and all that in there who are going to struggle. But if you have a look at SCP's announcement as to the impact as to, where they look at potentially having to give rental abatements and the like, it's quite small and definitely much smaller than what it would be for some of these regional malls.
All right, thanks, mate. I'll do one final question on retail, and then we can move on. There's a couple more questions on distributions. What protections are in place for players not taking advantage of rent moratoriums, and what's the incentive for continuing to pay rent? Which is, you kind of already touched on this, but yeah.
Yeah, look, I think that's one of the issues, right? That's one of the issues a lot of the landlords are, arcing up about is, some of these tenants were going to go out the back door. Are we going to see these guys just take advantage of us for 6 months and then walk out knowing that they're not going to pay any rent? So that's one of the things that's actually, in discussions with at the moment. What protections are, I don't think there's a lot of protection given what the government's come out and effectively said at the moment, but it's one of the issues that the landlords are, pretty keen to be protected. But yeah, just, as they've done, a lot of these policies have been thought up pretty quickly, and I get what they're trying to do, but from the landlord's point of view, yeah, I don't think the protection's that great in the short term.
Next one is on valuations. How do you value commercial properties? And again, you've touched on this before, is how do you value commercial properties in the market with tenant mixes that may or may not be affected by the current crisis? And I think you were saying before, it's not a capitalisation story.
No, this is an income story. And I was on a call with one of the big agency groups the other day, and they were talking about neighbourhood shopping centres and transactions, and they've had a few, and they said, look, there's a lot of high net worth and private investors that are still there to buy these type of centres given their resilient income streams. But the thing that really caught my attention was, once upon a time, they'd sort of look at the specialty type rent and just look at it in aggregate. They wouldn't really, get into it with a fine tooth comb and dissect it. But I think that's what they're doing now. They're going through it tenant by tenant and saying, will this tenant, survive? Have they got a long-term future? Yes or no? And sort of putting probability weightings, if you like, against it. So there is a very, very, very big influence on the quality of the tenants out there, right? Because that's the certainty of income. So if you've got a government building, like I know we have an investment in a building with 100% government tenant, well, the government's going to pay the rent, and people value that accordingly, right? Whereas if you've got a shopping centre where you've seen so many national tenants come out and say we're not paying rent and we want abatements and the like, then there's a lot of uncertainty about it. So the quality of the tenant covenant, as I talked about in the presentation, is absolutely paramount, and I think the market's going to focus more and more on that going forward.
Yep. Distributions, how do you see them play out in the short to medium term? I know you were touching on Transurban before, and some others pulling guidance.
Yeah. Look, REITs by law have to effectively pay out 100% of their taxable income, if you like. So, I guess the question is what that number will be. Look, whether they get a moratorium on not paying dividends for a year, I probably question that. But look, I think across the board, you're going to see dividends come down for a lot, not all. I think there's some out there, and I've mentioned some of those names, which I think their dividends are fine. VVRs and APAs and the like. I don't think you're going to see any impact really to their distributions, given the quality of the tenant covenants that are they're paying their income. But some of the others are, look, they're obviously going to be down. That said, as I said at the start, Omar, this isn't about what the dividend is in the next 6 months. To me, that's irrelevant. I just want to see them, come out, work with their tenants and come out bigger and better on the other side. For me, that's the focus.
This one's, we'll end it with this. It's 12:40, so we'll end it with this last question. Once the crisis is over, do you see everything returning to normal operations for the sector? I guess could be property or infra, or will there be some permanent structural changes? I know you've already spoken about retail and some shifts to online, both in grocery and broader fashion retail or specialty retail. How do you see other parts playing out? Like work from home, are we all going to work from home?
As I said, and I've spoken to a lot of people, I think they're really missing the office interaction. I know you guys are missing the office interaction with me. But yeah, look, I don't think that. And I think after a period of time staying at home with your families for such extended periods of time, I think everyone can't wait to get back to the office. I think, here's an example. I was speaking to someone this morning. They've got basically a disaster recovery tenancy in one of their buildings. Their tenant has rung them and said, got all their employees working from home now. Well, our lease is up in 6 months, 9 months. We don't need the disaster recovery anymore because we've realised tenants can, our employees can actually work from home. So, you know, things like that will change. But I think the big thing you'll see, and look, there's no question, and we've been arguing it for a while, that the differential between quality has really converged. You know, people have been paying pretty tight yields for, in our view, pretty inferior quality assets. And I think you're going to see that gap between, you know, quality and second tier type assets really separate again, which it should. I think that's a good, healthy thing. And I think you're going to see the strong are only going to get stronger, and, you know, you're going to see a bit of a shakeout. And some of those that have probably gone a bit too aggressive, a bit too early, are going to have a few challenges. So, but look, will it get back to normal? I think it's going to take a while to get back to normal anywhere. You know, I hope it gets back to as normal as it can, because, you know, I don't think anyone's enjoying, you know, what's going on at the moment. But, you know, you just got to keep monitoring, Omar, but I think the good will get better, and there'll be a few that fall away.
Thanks, Grant. Mate, appreciate it. Hopefully everyone else did as well. No doubt they did. Thank you all. And if you have any further questions, please shoot them across to communications@freeholdim.com.au, or I'll just put up my Grant and I details as well. So our details are here as well. Please email us. Feel free to get in touch directly, and we'll do our best to respond to those and keep you posted on how we see markets. Thanks, guys, and thanks for your time.